Welcome to the Gray Report. I'm your host, Spencer Gray. Every single week on the Gray Report, we break down the latest research reports, data, articles, and opinions revolving the multifamily industry. So whether you're an active investor, passive, or you work in the industry, you're in the right spot, and thank you for being here. We've got a great show today lined up. We are continuing our Jargon Bin series, discussing the term cash on cash. It's basic. It is essential to every deal. It's also probably one that's often misunderstood and confused. So we're going to go into not a deep dive, but we're going to explore it in three different layers, three different levels of understanding. But we've also got some really interesting reports we want to talk about. We've got some trends and forward-looking comments and reports by some of the nation's largest property managers and owners, Newmark, Cushman Wakefield, and AvalonBay. They're all out with Q4 updates and some insight into where they think the market is going. So we're going to explore some of the common themes between those pieces and get to the bottom of where we might be going in this market. Also going to be looking at just where we are in the market cycle. Integra Realty Resources is out with its 2026 market cycles report, looking at all kinds of different markets, where they are on that cycle, everywhere from in recession to hypersupply, oversupply, recovering. It's always a fascinating conversation of just kind of trying to pinpoint where some of these markets are. We're going to get into the details because some of it's not as straightforward as it may seem. All right, strap in. This is a great show. Griffin Haddad is joining us once again, co-hosting the Gray Report. Let's get into it. All right, welcome back to the Gray Report. Griffin's joining us once again, co-hosting the Gray Report, and has just an excellent agenda. Make sure, though, in addition to the podcast, the YouTube show, we've got a newsletter. You can subscribe to it, graycapitalllc.com/newsletter. Griffin leads the charge on that, and it's just one of the highest review newsletters in the industry. And some of these articles are coming straight from that piece. But before that, we've got the Jargon Bin to go over.
We do. It's week 4 of the Jargon Bin, I believe.
It's exciting.
Yeah, let's get right into it. We are talking about cash on cash return. Last week we talked about internal rate of return and equity multiple. Cash on cash return is the kind of third return metric that you'll see on Gray Capital pitch decks in regards to overall investor interest in the deal. So let's start with cash on cash. It's rather simplistic. So let's start with that basic understanding. What exactly is cash on cash? And can you describe or mention to myself and our listeners the equation to get to cash on cash?
Absolutely, because it's the absolute easiest formula there is in, I think, real estate investing. And so the main question that the cash on cash is asking is, how much cash did I receive this year compared to what I invested in? So the simple formula is dollars received, as in cash to put in your bank account or your pocket, divided by your dollars invested. So cash back to you divided by what cash you put into the deal itself. It's simple as that. Now, there's nuances. There's people look at it different ways. People confuse it with other terms. But simply, again, it's the cash that you receive divided by the cash you put in.
Wow, that's simple. So it's not the total money you're making, and it's not the speed of return. Rather, it's the income yield that you're getting today.
Yeah, exactly. So like some of those other questions or answers would be equity multiple, be the total money. The IRR is kind of like the speed of your return. Your cash on cash is your actual cash yield, your income yield today.
Wow. Let's go next layer of depth into cash on cash. I want to talk about how cash on cash is levered income yield on your equity. And so what an investor is actually receiving is that free cash flow. But how does the property kick off this cash flow following its total revenue generation? Obviously, there's operating expenses. Kind of talk about how that cash on cash return, that final product, gets distilled down to
so if you're looking at an income statement, and I think that's where you're getting at, is really kind of what is the line item? What's the math? And it's really simple. All your income, your revenue, you minus expenses, which that would be your net operating income. You take your net operating income and then you deduct any debt service payments, principal and interest, but also any management fees. I mean, it's the true, net cash flow. But we're also very simply, if you're an LP investor, it's that cash distribution that is sent from the property that LP investor receives.
Right. Awesome.
So it doesn't include depreciation. It doesn't
Right.
include anything like that. That's on the paper or a balance sheet, issue. It's truly after expenses, after debt services, after management fees, what cash is available to distribute, and then that cash that is actually distributed. It's different from just the net cash flow because you can receive net cash flow, where the property can be producing net cash flow, but that sponsor may retain some of that net cash flow into reserves. There may be a month where there's positive net cash flow, but the sponsor decides to withhold distributions to build up reserves. That would be a 0% cash on cash.
Understood. As an investor yourself and as an owner-operator, the ideal cash-on-cash return in a multifamily acquisition, I've seen folks confuse cash-on-cash with preferred return, with an IRR, with an equity multiple.
Yeah.
So let's talk about ideal cash-on-cash and how it is not preferred return and how they differentiate themselves.
Yeah, well, and this is the teaser. So we're going to be talking about preferred return on next week's Jargon Bin episode. So if you want to learn more about preferred returns, you're going to have to tune in for next week's episode. You got to subscribe to the Gray Report, obviously. But so the preferred return is essentially a return in a threshold in the economics waterfall where an LP investor will receive a certain annualized return before distributions are split between parties, typically, again, the LPs and the GP. So an 8% preferred return, I need to have received that 8% annualized return before the GP starts getting into the money and we start splitting cash flow. And so there can be an 8% preferred return, but the cash-on-cash return may only be 6%, leaving that delta. Again, it doesn't matter that the preferred return is 8%. The preferred return can be 15%, the preferred return can be 20%. That doesn't mean you're going to receive any of that money. That's just a threshold to start the next tier of the waterfall. Cash on cash is simply, this is the money is available and we're going to be able to send it to you.
Cash on cash, I think very similar to IRR, can always ebb and flow as you're underwriting a project.
Yeah.
But cash on cash in the midst of a hold period, in the midst of an investment, can increase and decrease year over year, month by month, based on some of those overall revenue generation expenses at the property level, at the asset. So as an investor, if you hear, there's an average cash on cash of 6%, I guess lay that out for us with the expectations of the LP. 1 year you may be able to receive 3% cash on cash, while the next year maybe you get 10% cash on cash.
Yeah. No, I think it's the average cash on cash metric is important to compare different investments, but it doesn't tell the whole story. You really have to look on annualized cash on cash. Because to your point, there could be 3% cash on cash in the first year, which is below what many investors may like to see, depending on the risk profile and the strategy of the investment. There could be 0%, or there could be a high degree of cash on cash. Maybe there's an interest-only period that burns off that allows for higher cash on cash earlier on.
You mentioned an interest-only period and its impact on the overall cash on cash returns. Leverage and debt and the way that we are financing our projects can really materially impact overall cash on cash returns to our investors. Just talk briefly on the impact of how you are establishing your financing or what kind of debt you're placing on the asset and how it impacts overall cash on cash.
I think bottom line, the leverage is hugely influential into determining what that cash on cash could be. I mean, if you have double the equity that's required for a project, your cash on cash is going to get cut in half. Conversely, if you need half the equity, your cash on cash is going to double. So the more leverage that you use, theoretically, the higher that cash on cash is going to be. Now that could impact your total return because you bring less equity on, but your cash on cash is significantly influenced by the amount of leverage, but also interest only. Typically, especially like in an agency loan or a bridge loan, there's a certain amount of years where you only have to pay interest. You don't have to pay down your debt or principal at the same time. This can accelerate cash flow, but it's good to know you're not paying down the principal of that loan balance over that period of time. Higher cash on cash earlier, kind of going back to our IRR conversation last week, more cash on cash earlier on, you receive money quicker, can influence that overall IRR and total return profile as well. So leverage is key. And again, the same property, the same investment purchased at the same purchase price can produce vastly different cash on cash yields depending on how you lever it.
Interesting. And you had mentioned the principal payments, so the pay down of the principal balance of the loan.
Yeah.
Those principal payments, those do not get equated
Exactly, correct. And this is where I do get some confusion sometimes. I'll talk to, LPs, which surprises me, but also GPs who want to include some of the mortgage pay down or paying principal as a part of your cash on cash return. It's really a balance sheet component and a component of total return. Well, eventually will turn into total return, but you may be paying down that principal, and that does start to slightly de-risk the asset because, again, you just have less liabilities associated with it. But it's an unrealized return. You're not actually realizing it, where cash on cash is a realized return. It's the money you're actually putting in your bank account or in your pocket, not dollars that are going down to pay down debt service. That's important to know that when you are amortizing a loan, but it's really not a component of cash on cash. The reason why it comes up is because when you start amortizing after an interest-only period, cash on cash declines. It goes down, and investors often ask sponsors, why did our returns go down? Why did my cash on cash drop? And the sponsor's response is, oh, well, now the loan is amortizing, but wait, that's a good thing, because if you actually add the dollars that were amortizing, your return is your cash on cash plus that principal amount, based upon your percentage of equity. And so they kind of spin it as a positive. And not that it isn't positive, but it's not a cash-on-cash return.
It's got way more of an impact on the total return, the IRR, and the equity multiple.
Exactly.
Understood. Let's get to our last level of depth in regards to cash-on-cash. And I've seen this occur in our projects. You have a capital event. Let's just say a refinance. You're able to return a certain percentage of your investor's capital. And so now you have an original capital balance versus a current capital balance. How does the cash-on-cash calculation alter or changed based on original capital invested versus the current capital balance following a refinance?
Yeah, no, this is a really important component to understand, and I really like looking at both. You're familiar with our underwriting model, and we have both an original and a current cash on cash metric, and the reason for that is we love the idea of getting to a point of infinite return. And the only way you can get to an infinite return is basically if you have $0 in the project, and then when you're taking your whatever you receive divided by 0, it's essentially infinite, or your calculator breaks.
Yeah.
Obviously, you had risk up front, and there still is always some liability that can be attached. But the way we get to that infinite return is if you're looking at that cash on cash calculation, not just by what you put into the deal originally, but how much money you actually still have left in the deal. So by taking it on current balance or your current capital account balance, you're factoring in the capital that has been returned to you. So let's say, for example, you invested $100,000 into a project, you're receiving an $8,000 a year. $8,000 divided by 100, that's 8%. So 8% cash on cash return. That's great. Let's say the property refinances, and through that refinance, $50,000 is able to be returned to you. That's great. It's a return of capital. That's a return of 50% of your invested capital over your equity. Your updated capital balance now shows $50,000. So now if you take that $8,000 divided by $50,000, all of a sudden that cash on cash return is 16%. Now, I think it's important to look at it both ways. One, just relative, relatively what I put into the deal, keeping things consistent, using the original capital balance and saying, hey, look, the deal's doing 8%. But I think it's always important to understand, how your money is working for you and your actual dollars that are in the deal. And the reality is, if you look at the money that you have in the deal divided by, or the money that you receive divided by the money you have in the deal, you do see a significant increase in cash on cash. I don't think that I think it's always important to understand both, and like that's why in our models it's very clearly labeled the difference between the two. But I think it's important to look at it because again, there have been examples, and I've done deals like this where we've been able to pull 100% of the cash out. There's even been deals where we've been able to pull 100% cash out more than once and still own it. So, we put in, $1 million, we receive $1 million back from a refinance. And then a couple years later, we can receive another $1 million back. Now, the cash flow that we receive, again, we can look at it as, that balance, the cash flow based on the original investment. And again, that's a good kind of relative marker of like what it's still throwing off. But the reality is that our money is no longer invested in the deal. We don't have any money in that project. The chips have been completely taken off the table. So it's not wrong to show that infinite return. It's just, again, it doesn't really work so well on a spreadsheet.
Yeah. Right. That's interesting. The cash on cash metric, obviously, it can be misleading. It can be slightly confused. But at the end of the day, it is largely driven by overall leverage or debt on the asset.
Yeah.
And then, I think the idea of the interest-only period and the use of financing, if you're an investor, you see would be more robust or larger cash-on-cash returns, more likely, and then dwindling across the whole period as that amortization begins. It's a good thing for, I think, our LPs to understand. But then at the depth of this conversation, the difference between the overall cash-on-cash returns based on original capital balance or existing capital balance, I think that can really kind of create some confusion. All of a sudden, you're an investor, you see, we're getting a 16% cash-on-cash return. Holy cow, this deal is doing fantastic, when in reality it's basically doing the exact same as before a refinance. So it's just all about a perspective and a lens. So let's close up the cash-on-cash conversation. What do you think about, when you think about a 10% cash-on-cash return? Is that high? Is that expected? What do you think?
I mean, it's all relative on the deal, right? The risk. But yeah, no, in today's market, cash on cash, if you're a common equity investor, a 10% cash on cash return is an incredible return.
Okay.
Most cash on cash returns that we're seeing, like out of the average cash on cash, is typically between, call it, high sixes and 9%.
Okay. If you saw that 10%, what are you asking yourself as an investor?
Well, I'm asking myself what am I missing?
Okay.
I'm also asking, am I investing in common equity? Am I investing in some sort of preferred equity? Because again, that's just a high level of cash on cash. Now, if it's preferred equity, it's typically it's consistent returns because you're typically just clipping that coupon. I'm clipping a high preferred return. But there's ways that you can manipulate cash on cash, and people talk about, and we talked about last week, of how you can manipulate IRR. Well, cash on cash is one of the methods how you manipulate IRR. Again, we talked about front loading that cash flow. So one of the easiest ways to manipulate, not just cash on cash, but the overall, also the total return of the deal, is if you accelerate any of that growth in the first year. And again, I used to invested in deals as an LP, and the big questions I had, this is when I was starting out, is there's this discrepancy of where the T12 is, where their actuals are compared to where like month one and year one of the sponsor's pro forma, and I'd noticed that basically the pro forma has all of the work being executed, and basically rent's already re-signed, or the lease is already re-signed at the new pro forma market rents in year one. The reality is it takes some time, but by front loading all that growth in year one, you're compounding on a higher basis of growth, and so you can produce a higher cash on cash throughout the overall hold period. But what it's missing is that potential period of stabilization. So other ways you can manipulate cash on cash is, again, using heavy leverage, your interest only periods, and then what your rent growth assumptions are.
Yeah.
If you have 0 or the 3% rent growth, well, that's considered very conservative. If you have 5% plus, well, that could be seen as pretty aggressive, depending on the deal, depending on the market, et cetera. So there's a lot of ways to manipulate cash on cash. The question of what is a good cash-on-cash return is evolving. It's different. It's changed a lot. When I started putting these deals together, we wanted to see cash-on-cash never dipping below 8%. Most deals we would, and again, we structured deals a little bit different when I got started. Typically, we'd be closing on a bridge loan while we put a permanent HUD loan in place. And we might be on that bridge loan for a year. And that bridge loan was interest only. The HUD loan would be fully amortizing. But we could achieve double-digit cash on cash often in year one because we were buying properties at kind of 6.5% to 7% cap rates, doing a value add, pushing up some revenue, and that would produce strong cash on cash returns. Again, double-digit cash on cash returns. And then once we refinance, put an amortizing loan on, it would drop it down, but it would typically drop it down to like 8.5%, 9%.
Interesting.
And so still solid cash flow. Those days, though, are gone. Interest rates are higher. Cap rates are still lower. So like I said, we're seeing cash on cash typically out of the gate between 5 and 6 is pretty normal. We like to grow it to 8%. Some deals it's hard to even achieve that, but that's what most deals are looking like today.
And now we're out there searching high and low for
I don't think we're going to win it. So again, don't get too excited, everybody. But we were close. We were close on a deal that had some just great cash on cash return. It was partially driven by the cap rate. It was a little bit more of a market that not as many people are going into, but it got me really excited. Because, again, it wasn't that same level of cash on cash, but it was really good. It would average about 9.5% almost, and it hit 10% in some years, and we just haven't seen those types of yields. Now we have like properties in our portfolio that are crushing it on cash,
right?
And again, why is it? It's because of leverage.
The financing.
Villas on Fur, which is one of our more successful properties that we own, partially because where we bought it, but it's how we financed it. And we've gotten great net operating income growth, NOI growth, but it's because we were able to put this HUD 223F loan at a 2.7% rate, amortized over 35 years, and essentially, from when we bought it to when we put the loan in place, the leverage ended up being, bumped up to, kind of like the low 80%, which is a high degree of leverage. We've never levered anything that high, but the cash flows and the growth really supported it. And it's been producing, 14, 15, 16% cash on cash returns, true based on original capital cash on cash returns. They'd be close to 20% cash on cash on existing capital accounts. And it's a Class A property that we didn't have to execute value add in. Right. So you can get high cash flow in surprising places. But again, the reason why we're able to cash flow villas is because of leverage. We've looked at similar deals, same purchase price,
totally different debt.
Totally, the leverage is completely different. We're having to bring double, almost triple the amount of equity, and the returns are unsurprisingly half or less.
Let's tie a bow on cash returns. It's not a return metric that's quantifying how fast you're getting your money back. It's not a return metric that's telling you how much growth or how much money you're going to be getting back, but rather it's a quantifier and a metric of income that is measuring how much cash you're receiving based on your initial capital balance or your existing capital balance. As somebody that's investing in a private placement in real estate, you should be asking yourself, how is this cash on cash metric being generated? Where is the income coming from? What is the leverage that's driving it? Is there an interest only period? When does the loan begin to amortize? And then what does that total return look like? And how does that cash on cash get you to that total return? Anything else that people should know about cash on cash return that maybe we haven't already mentioned?
I just think cash flow is just like the lifeblood of any deal. And so just a healthy amount of cash flow, it provides a large kind of margin of error. I like to see healthy cash flows. We're cash flow investors. We feel like even though sometimes you have to buy a high cap rate deal that may not have the highest chance for appreciation to receive high cash flow, I found finding a really well balanced deal with good cash flow will always have a market. It'll always have some liquidity, and find more success when your deal's a little fatter and it's not as skinny. Again, low cash flow means skinny. That means you're closer to your debt service coverage ratio kind of limit, which can be another jargon bin term. But a lot of cash flow means the deal's healthy, but you just don't want to confuse it with. You also have to equate it with risk, and get a higher rate of return usually also means a higher degree of risk. So understand what you're getting into, how that cash flow is derived, and understanding the assumptions. but that's it.
Cash on cash return.
Yeah.
You come to Gray Capital if you're looking for cash flow.
Well, I mean, we always have been cash flow
Yeah, we
first
have.
investors, and I mean, we want to look at the total return because it is just one component. But again, just coming back to like, it's a durable deal. If there's cash flowing, you can hold on to it. You can You don't necessarily need appreciation if you have a long enough return horizon.
Yeah. I think and this is, jargon bin is over.
But I was talking.
I do like, I had this moment a couple years ago as I joined your team that I had seen some multifamily commercial real estate deals come through on an LP side, and most of them were development deals.
Yeah.
And as a young individual, not super focused on cash flow, the gentleman that was essentially marketing the deal to me just said, "Hey, here's what we're going to do. I need X amount of dollars. We're going to invest it in this project, and in 5 years, we're going to give you two times that much back." Great, awesome, fantastic. Seems like a good deal. Why not? I trust you. And then you start doing a couple of those, and you start to wonder, well, most of these investments, they kind of somehow come with some income. They're usually spitting off some kind of like dividend or distribution. So I'm like, where's that? It's amazing how little cash flow some of these private equity real estate deals can have, because they are development deals, and you have to have the right mindset. You have to be the specific goals with how you're investing into real estate. If you're not looking for cash flow and you're speculating, you want to speculate on growth, development might be the right route. But if you are looking for some income, the existing stabilized asset may be more for you. But it also, there's a level of risk that's inherent to the development deals that otherwise is not as inherent in the existing asset. So it was a really interesting kind of perspective change or learning experience to try to understand why existing multifamily, stabilized multifamily, has pretty palatable cash on cash returns versus the development had zero.
Well, again, that's why I think stabilized multifamily is always in such a great sweet spot from an investment or profile, because it has qualities like a bond or an income product that's going to produce. It's going to throw off cash flow, and it's tax sheltered, so you can utilize the depreciation to shelter that cash flow and that income. Because when you acquire the property, you do a cost segregation study, you generate a lot of paper losses that you can use to offset that income. So again, tax adjusted, you have to get a 6% cash on cash elsewhere. Again, taxable, you might have to go get 8 or 9% actual yield. That after tax it's down to 6%. Multifamily, 6% is 6% because it's typically it's sheltered. But then it's not just the income. People be happy about 6% return, but you also have the opportunity to double your money.
Right.
And so you can
While
get
you're
great
earning that
upside
6%.
while you're getting yield.
Yeah.
That's where it's really attractive to both income and growth investors. And and then the fact that it's slightly uncorrelated from other markets or less correlated to other markets, that's where it can be one of the best diversifiers. And not to, again, we're going to get into the weeds and into deep end of the jargon bin.
It's the fourth level.
But when you look at portfolio construction and getting out you're looking at your Sharpe ratio and getting into the efficient frontier, which is essentially a position of your portfolio that allows you to achieve a higher rate of return while taking less risk. And it's achieved through diversification and uncorrelated assets. And again, multifamily is just absolutely in that sweet spot that does that.
Right.
I don't even want to get into why real assets in the next couple of years are going to be so exciting, because all this technology is so crazy.
It's an exciting time.
That's a whole other topic that's not even on the agenda.
We should have a new branch of the Gray Report podcast where we just sit around and speculate.
We can fit it in. We'll be able to fit it in. Let's move on to these reports. Okay, we got 3 reports: Newmark, Cushman, AvalonBay. We've got some takeaways. They're all kind of Q4 25, but with some outlooks into the future, I believe.
Yeah, so
Bring us in, Griffin.
The Newmark report is based off their portfolio trends in Q4 of 25. The Cushman Wakefield is the top trends across their multifamily portfolio within the last year. And then the AvalonBay is a full annual review of their 2025 results. I read all of them. I've got 5 common themes that exist within each 3 of these reports. I want to say the themes, and then I want to talk about how you feel about each theme moving forward into 26 relative to Midwest multifamily. How's that sound?
Yeah, let's do it.
First theme is it's talking about the supply. We talk about that supply cliff all the time, and we've seen it, and we've talked about it for weeks. But the first common theme across the three reports is that the worst of the new supply is behind us, and early in 26, we're setting up for the recovery of multifamily fundamentals across the nation. How do you feel about that?
I think that's a little optimistic.
Okay.
I don't think it's wrong. I just think early 2026. Well, that's now. That's today. And we'll really see in the next 30 days or so, maybe less, on when we start getting into leasing season. March last year kind of kicked off leasing season a little bit earlier. Let's see. I'm assuming that's going to be the same this year, but let's see how leasing season goes. It's true we are delivering less units this year than we are last year, but that doesn't mean. But the units that we delivered last year are still here, and we're still dealing with them. It's not like the units are delivered and they go away. It's more supply in the market, more competition in the market, less pressure on rents, and typically. Again, we've seen vacancy more or less, peak, and there's some evidence that maybe vacancy is coming back down, occupancy is, recovering a little bit, but we haven't seen those green shoots just yet.
Right. I saw some graphs the other day in regards to the average number of days on the market, or days available or vacant as that unit sit, and it seems like it's right around almost its peak for I don't want to say the number of years, but in that graph, how they've cropped it, it's at its high point. And so it just feels like the demand still hasn't truly caught up to the supply that we've been seeing in the past. And maybe that's why we've got rent growth deceleration or negative rent growth across the nation.
Yeah.
So with that, the second common theme across these reports is that demand is not collapsing, but it's momentarily pausing in preparation for normalization.
I mean... So say that again. So demand
is not collapsing.
Yeah.
It is momentarily pausing en route to normalization. So it's on the mend.
I hope so. I mean, I think that's wish. Again, I think it's kind of very similarly optimistic lens. And I think that yes, things will normalize. I'm just not confident they're going to normalize by the first half of 2026.
Right. Let me ask you this, because
I could be wrong though. One of the reasons I could be wrong, there's a ton of tax refunds that are going to be coming back starting in February into March. I think that coinciding with leasing season, we could see a strong pickup, and that could spur some demand. So I think that would be the element that would facilitate for that to happen.
Yeah.
Also, this idea that people are just so numb to uncertainty that we're just over it.
Right. We talked about this last week, how our portfolio, on average across our portfolio, we were seeing some lower than normal occupancies.
Yeah.
And so it's obviously we are feeling here at Gray Capital some of this suppressed demand, or maybe it's just the increase in supply in the market.
Yeah.
They keep building these apartments, and we've talked about it about the north side of Indy. They just continually keep building them. And so there's all of these demographic studies that these developers are doing that they otherwise think in the next 2 to 3 to 5 years, the demand will be there, or else they wouldn't spend all the money to build these assets. And so when it says demand is not collapsing, I'm curious as to what it would look like if demand is collapsing.
That's a way to say that demand isn't good.
Right.
But demand isn't collapsing as it's like, well, the world isn't falling apart.
Yeah.
But that doesn't mean all is good. That means like it's not an absolute worst case scenario.
Right.
But like there is some demand, because demand has declined significantly from where it was in the middle half of last year. Part of that is they built it, people did lease up apartments. Vacancy didn't absolutely. I mean it increased.
Yeah.
But it's not like it crushed the market. Mm-hmm. I mean the units are being absorbed. They're just being absorbed at lower prices than the developers want, and it's putting downward pressure across the system.
Right.
And then again, I just think some of the uncertainty and lack of affordability elsewhere is putting pressure on that demand slowing down.
The next common theme is that there is a flight or a search for quality, and it's defining this cycle. And so it's primarily I'm talking about how the A-class assets are performing in regards to B and C class assets. in my opinion, after reading these, it's due to some of that suppression of rent growth, and it's just you can attain as a renter, you can attain more value for a more affordable price moving into these A class assets than you can in the B and C class.
Yeah, I'm continually surprised. Again, going back to looking at that kind of that 80s vintage high cash flow deal earlier.
Yeah.
The cash on cash returns were good, but one of the reasons why we couldn't get any more aggressive on it is that the rents weren't so far away from the Class A, because Class A haven't been able to push the rents. They've even taken the rents down a little bit. And so if I'm living in like a okay but old 1980s product, and I have the opportunity to move into something that's brand new and pay just a little bit more money for it,
Yeah.
That's an easy
Seems
decision.
like a no-brainer. Yeah.
It seems like it's a no-brainer. So that it makes sense. Also combined, not just is the value there on these Class A, newly delivered product, but let's also go to the beginning of the this chart from Newmark, where renting remains significantly more cost effective than home ownership. That gap still remains, and so you've got a lot more people that would have been buying homes, who are by definition somewhat affluent, pretty affluent, to have the money, unless you're doing like a VA loan.
Yeah.
If you have the money for the down payment, you're in the haves category for sure.
Right.
So those people are, a lot of those, not all, a lot of those are renting, and they're not going to rent B-class apartments or C-class. They're renting A-class.
Do you have the AvalonBay PDF accessible?
I do.
Let's go to page 7 real quick. They have the same chart. I just want to briefly compare them. Now, I believe they backed out of apartment rent, less apartment rent. There's the spread there just looked a little bit larger visually at $2,100.
What do you think of these
What a
these
time!
graphs?
Yeah, what a time to be alive back in early 2020, 2021 as a homeowner or a renter. It was more effective and affordable to rent in 2020, 2021.
Yeah.
Is that what that's saying?
Yeah.
And then the spread has grown to over $2,100 in a span of 5 years.
And that's not as big of a spread, I think. Well, I guess that's the growth.
It just looks large. Yeah, that's the growth. I was just curious as to trying to compare those two.
Yeah, it's
pretty
a
close.
similar
It's
gap.
pretty close. Interesting. All right, the last theme. What was the last theme? No, there's 2 more themes. Sorry. We've talked about this in the past, Spencer. The 2026 is an occupancy first phase or cycle of the multifamily cycle. In this year, it's not a rent growth phase. General thoughts on that? I think we've seen it just in regards to our occupancies in our portfolio, but also just the strength and rent growth of renewals comparative to new leases.
Yeah, I just think it's most operators are seeing the reality and are playing defense and saying and understanding that it's expensive to move. So, protecting the back door, which means focusing on renewals, making sure people aren't leaving, has been a high priority.
Yeah.
And saying like, well, you can start seeing a really bad problem if not only are you getting no new leases, but people are also leaving. So first thing, let's retain our folks. Maybe we can get some rent growth on renewals, which there's been a lot of success in getting rent growth out of renewals, because again, if you still have a job, you've probably experienced some wage growth, and moving isn't fun, so people don't want to move. So don't give your residents a reason to move. So focusing on retention has been key. It's been good because people don't want to make a big financial decision and move anywhere right now. And then, but then because it's harder to predict what you're going to be able to achieve on your new leases, your new lease rent,
right.
And very few operators right now are choosing to get very aggressive on rent growth because there's not the data to really support any rent growth. Again, it'll be really, really interesting in a month from now when we get into leasing season, what that shows. Maybe these tax refunds spur some demand. We start seeing some growth. And one lesson, again, that I learned definitely in the pandemic, where I observed watching multiple operators and being right in the middle of it, is it can turn, and it will turn. And we will start seeing some really strong rent growth. There will be some operators that won't believe it and will miss out on an entire year of rent growth.
Wow. brings up the last theme, and that theme is that capital is coming back, but cautiously. I think we've seen this within our internal operations and our investor relations department. There's a general interest in allocating to the asset class. Capital is posturing on the sideline. Capital is preparing to be deployed, and the capital that is being deployed seems to be a little bit more picky and a little bit more cautious. Just as you mentioned that, things can change, fundamentals can swing in favorable or unfavorable ways. It is our kind of disposition here at Gray Capital that we are entering into a really advantageous period of time to be buying real assets, multifamily assets in particular. And so just in the conversations that you've had when we go to some of these events and conferences with existing investors, prospective investors, and other owner operators, do you sense or do you agree that capital is indeed, kind of coming back and is ready to be deployed?
In short, yes. I would argue that the capital had never completely left.
Okay.
There were large capital players that had certainly left, or categories, and some that are still on the sidelines. I would also say there's probably new entrants that are getting into the market. I've been kind of surprised of that. You think that like everyone and their mom's already invested in multifamily.
Yeah.
But then I've talked to a lot of folks recently who had gone big into self-storage or gone into senior housing or whatever or industrial, whatever the asset class may be that they chose the last cycle. Now they're starting to get really interested in multifamily. A lot of that is I think that they were interested in multifamily in the latter half of last cycle, but had already had a strategy and just kind of thought it probably was getting a little frothy near the end, and they probably thought they understood their other asset class that they were investing in. And now that prices are down 20%, things are starting to look attractive. Not every deal is looking really great, but they're starting to get closer. And it's this idea that supply probably is going to be, slowing down. It's probably not falling off a cliff, but it's going to be slowing down. There will be some sort of rental recovery. The data shows that it's extremely rare, almost never, that there hasn't been a large rent spike after several years of declines, even though we had a big spike back in 21, 2022. We should see some above trends, which means above 3% rent growth at some point in the pretty near future. At the same time, no one's getting that aggressive on rent growth, and net operating incomes are flat or negative. And so the pricing is actually getting a little bit better because, the cap rates may seem like we were talking about this the other day. Cap rates may actually appear like they're getting lower, but which means prices you would think would be going up, but really the prices are just kind of maintaining because the sellers need to get their price, but their actual income that the properties are generating is going down. And so the cap rate is also going down because you're having to pay more for the same income. Now that does a couple things. One, it prevents new buyers from over speculating on that asset, because if you have negative net operating income in 1 year, well, how much growth am I going to bake in the next year? You may bake in some. You may say, well, there's going to be recovery. You may say, well, I'm going to do some physical improvements to push rents or bring in a new technology stack to lower expenses. But you can't do that on top of organic rent growth. Typically, you'd have whatever your business plan would be. And that growth would be on top of any organic growth. It's like all the rents in the market are going to go up 3%. Well, okay, but we're also making the place nicer, moving it to a next level. And so we're going to probably receive another $100 per month on these units, plus that 3% organic growth as the whole market continues to lift. With 0%, organic rent growth, that equation becomes more challenging. You certainly just can't get as aggressive, which is why we think it's a good opportunity to find deals that, again, once you go back to where the rents of the property were maybe a year ago, and the business plan all of a sudden is like, we don't really need to achieve anything that hasn't been done before. We just literally need to get rents back to where they were 2 years ago, normalize expenses, and then maybe there's a value add component that makes sense, that either that kind of defends the price point, or that can push it into another category.
Yeah, interesting. That is the 5 common themes across those 3 great kind of backward-looking articles and data points from Newmark, Cushman Wakefield, and AvalonBay. I want to bring up the Integra Realty Resources 2026 market cycles graph. And specifically, I want to go to the multifamily chart just to take a look at some of the markets across the United States and see where they are in the lens of the Integra Realty Resources group in regards to where they're positioned in the cycle, the expansion, hypersupply, recession, and or recovery. I went through this earlier, Spencer, and tried to kind of pull out our beloved Midwest markets. This is the industrial market cycle.
Oh, yep.
That is the multifamily. Just went through and tried to pull out our beloved Midwest markets, and I would just be curious as to what your thoughts are, starting with Indianapolis on the right side of the screen in the middle triangle of the hypersupply.
Yeah.
What do you think about that?
Yeah, it was interesting to see. And while I was surprised, I also didn't necessarily think it was wrong, but I thought, the relativity is I think a worthwhile conversation. But hypersupply isn't exactly where you want to be. That's right before recession. It's not exactly the point where you're excited about an entry point. Mm-hmm. The reality is, Indianapolis, like many other markets, has built more units than it had in a long period of time. The difference was, I think, Indianapolis, delivery of existing units or delivery of new units relative to existing, I think, was peaking out of kind of like the high 6% range, whereas some markets in the Sun Belt did, 10, 12% for multiple years. Mm-hmm. So I think, relatively, Indianapolis did build a lot of units, but not nearly as much as some of the Sun Belt counterparts. But, that being said, there isn't a lot of supply. I'd say it's pocketed. I mean, in the Westfield submarket, Carmel, there's tons of new supply, and I don't think rents are really growing much up there. Now, I think they will eventually because you've got the demographics, you've got the in-migration. The property we bought on the south side of Indianapolis, I think, is a very different story.
I would agree.
Almost no new supply. I mean, there's one other property that had been delivered, was in lease up, but like that was kind of it. And we're seeing strong positive rent growth. Mm-hmm. And just in general, like Indianapolis is not volatile. Like, we'll see like, a month of negative rent growth in winter, which is kind of just seasonal. Yeah. But it's been really pretty steady. It used to be slow and steady. Now I think I would just define it as really steady. Yeah. So like the trough in Indy isn't that extreme. Now you could say the peak isn't. Mm-hmm. I would argue that the peaks have been growing and the troughs have been kind of similar. At some point, if Indy gets into really high growth mode, and we're far away from that, but might see the high peaks and the larger troughs, more equal periods. But right now, if this is the worst, I guess this is before recession on this chart, but if this is kind of the worst it gets, it's really not that bad. But that's also why we're still looking at Indianapolis. We're still looking at Cincinnati, which is in hypersupply. We're looking at Columbus, which is in the just between expansion and hypersupply. We mentioned St. Louis, which says it's in hypersupply, which again I think is just kind of silly because there's not that much that's been delivered in St. Louis. Again, this market that we were looking at recently, there hadn't really been anything really delivered. So in there, it's Integra's definition of hypersupply is increasing vacancy rates, moderate to high new construction, low negative absorption, moderate low employment growth, and medium low rental rate growth. And the one reason where Indianapolis absolutely does fall in line is the vacancy rates are relatively high. And Indianapolis has historically been a market with relatively high vacancy rates as well. So
let's jump to the opposite side of the cycle here, and let's enter into the recovery. Columbus, Ohio, is on our list, but there's Cleveland, Ohio, and there's and Chicago, Illinois. In the recovery section. Cleveland has not been a market that Gray Capital has been looking closely at. What does that mean to you? I mean, Chicago, again, we're interested, but it's got to be a specific county, and it's also could possibly be within Indiana state lines to be in the MSA of Chicago. But Cleveland, Ohio is within our radius, but it's not necessarily a target market.
Yeah, actually, Addison and I were talking about Cleveland earlier today, and correct. It is not. Cleveland is not a target market of Gray Capital's. Cleveland, I've always described as pretty not just slow growth, but really negative growth.
Really?
I think if there's one, it's very much in that true kind of Rust Belt market. But that being said, there are some attractive suburbs of Cleveland. There are some pockets of growth, and that's where you can find some great opportunity. Now you just have to know what you're getting yourself into. So I would do a deal in Cleveland if the cash on cash was really good. Buy at a higher cap rate, you get some really good cash flow, and you don't necessarily assume you're going to get any cap rate compression. You expand the cap rate, and you're comfortable with that terminal exit. Maybe it's a lower IRR, but it's really more of a yield play. And you're like, look, I'm probably going to sell this thing for what I bought it for, even though that's probably not the case. But I'm just going to cash flow this thing for 10 years. You're going to throw off really good yields. And that's going to be, how I'm going to de-risk it is just because of how much cash flow there is.
Right.
Just knowing you're in a market that has less liquidity, you're rowing upstream a little bit because, again, you don't have the population growth in the broader market. So you want to be in the pocket that does have some growth or is affluent enough to where there's some real demand. So, good schools, good incomes, and, good location at the right price. And that's the most important thing. If you can buy it at the right price, I could be convinced that I would take a look at something in Cleveland as a cash flow play.
There's one other market in here that I want to spotlight for our purpose of this conversation, and it is going to be Grand Rapids, Michigan, just in the initial phases of the expansion.
Yeah.
Grand Rapids has been on our board for a long time as a potential market of interest, along with some other Southwest Michigan markets. The thoughts on Grand Rapids, from your perspective on an acquisition standpoint, it's a little bit maybe far away from our corporate headquarters, but if the opportunity was right.
Well, yeah, it's definitely on the list.
Yeah.
We like Grand Rapids. I mean, it has some really strong demographics. Has a lot of good kind of net in migration from Michigan and elsewhere. It's got a whole lifestyle component, slightly younger population.
Right.
I really like Grand Rapids. It doesn't get not a lot of people are going after it. We like going where others aren't. It gets cold. It's a little far away from us, but not terribly far. I think one of the reasons why we consider it more is our chief investment officer Jay Reeder lived there for a while, and so he's just in general more familiar with the market. I absolutely take a look at deals in Grand Rapids.
Is there anything on here right now that you see that sticks out for mention? If not, I want to take a look at the industrial and the office and just see where Indianapolis sits.
Yeah, I'd like to move that. The only comment I have is just look at all what's in that the hype between kind of in that hyper supply bucket. It's the vast majority of markets. Not that there isn't a splattering across the kind of through the recession. And see, I guess I'm surprised that it has Austin, Texas in recession. I might push it back a little bit more on I think
it's got Austin, Texas in recovery.
Yeah. It does have, it has it in recovery. Yeah, I'll have to look at the vacancy rates in Austin. We know that there's low new construction isn't accurate. There is high new construction. The absorption has been good. The employment growth has been good. It has definitely it checks the box on the negative low rental growth rate growth though.
Yeah.
So maybe it's accurate. I think. And I'm sure this will be the case, although I don't know how it will with all this supply still coming online in Austin. But man, people are so convinced that Austin is just going to come back. And again, I'm sure it will. But
the chart is very saturated on the right side of hyper supply. I would say a majority % of the markets listed are in hyper supply. There's 14 up top. I don't know how many. It's got to be at least 25, 30 markets over there in hyper supply.
Yeah, it'll just be interesting, because these markets, when they do this, they don't always move from one to the next, to the next, to the next. Sometimes they can kind of jump
around.
So it'll be interesting because one could go from hyper supply to kind of recovery, not necessarily skipping recession, because recession is really increasing vacancy rates. In hyper supply is increasing vacancy rates, but just by other definitions, you could jump from hyper supply to recovery relatively quickly. But going back to industrial, seeing where those markets are, it's it's still, there's a lot of supply coming online.
Hyper supply, yeah. Yep. There's a lot of markets in that hyper supply category in this industrial section. I would say it's not really maybe a surprise to me to see Indianapolis in there. We're a crossroads of America. We are a logistic leader in the United States. We are attached to major metros and continually seeing freight, and whether it's railroads, 18-wheelers, air freight, FedEx. It's we have a lot of square footage of industrial space here in Indianapolis, and even if it is hyper supply, I think the demand in Indy will be able to absorb some of this industrial space. Just a matter of time.
Geographic advantage.
Right.
It makes a lot of sense.
It's also interesting to take a look at Indianapolis in regards to the office sector, which is, I think, the third slide. And I know this is maybe a little off, but since we're in Indianapolis, it's kind of interesting that we are in recovery in regards to our office market cycle. I've seen some news about the north side of Indianapolis in regards to that Keystone area where there's...
I think it's important to note that a lot of the office market is at the latter half of recession or in recovery mode. Again, does this encapsulate all of the challenges with office? Probably not, because the cycle has changed. But there is, I think, a bottoming out that's going on. And I think... office, there's still a question of a lot of B-class office space that no one's super interested in. But it's all at a price point now where I think a lot of it kind of makes sense. I mean, if I wasn't just so bullish on multifamily, I would think that, I think there's some opportunities in office right now.
Sure.
And again, when you can buy something and if it only needs to be 50% occupied and it has good cash flow, then, maybe that makes sense. If you have the money to make something look pretty nice, because office tenants, they don't just want like a space to work at, they want like a nice environment to be in, and so you have to be able to provide that. Again, it's just not my asset class of choice.
What do you think is going on in Charleston, South Carolina?
I don't know.
Office expansion.
Charleston is it's in a sweet spot.
It's a good place to live.
I mean, at NMHC, all of the economists were so bullish on the Carolinas. They're just jonesing for the Carolinas. And even though they've built a ton of supply, between Charlotte, Raleigh, Charleston, Greenville, I mean, there's a lot of interest in the Carolinas, and just very favorable demographics, a little bit just more mild weather than maybe Florida, a little less crazy, just a lot of jobs, a lot of things to like about those markets.
Right. That's my wife. She also loves the Carolinas.
It's a good
She's jonesing for the Carolinas as well.
Yeah, she's jonesing. Okay.
Well, let's just because we only have one more chart to look at. Let's flip to the retail market chart, and I just again want to point out Indianapolis, just because that's where we're located. On the left side in recovery, again, it seems like there's a lot more retail in recovery rather than in hyper supply.
Which makes sense. I mean, think about what everyone was building during the pandemic. It was multifamily and industrial. And then what were people not doing? Office and retail.
Yeah.
That's the story here.
5 years later, and they're all
5 years later.
Back.
What did we build and what did we not build? That's exactly what this is. And I think retail has been a major winner, and I think will continue to be, because retail gets painted with such a broad brush. Whether people think all retail is malls or all retail is a shopping center, and it all is retail. But high street retail, a grocery store anchored retail, like there's a lot of different types of retail, and every street corner, every deal matters. Does
this get you excited at all about the potential mixed use acquisition with a grocery anchored multifamily asset? Or
Oh well, I mean, grocery all day long. In the right retail, 100%. The reservations are not, and it has nothing to do with operating, is just, it always comes down to financing. How much retail do you have? Typically, you need to be under a threshold to be able to finance it, or you have to condo it out and finance the retail separately from the multifamily. And then the buyer pool can be smaller because not everybody wants to deal with retail. Even if you don't have to condo it out, it's a small component. A couple stores on the first floor. You've got a podium, construction, 5 stories or whatever.
Yeah.
Retail on the bottom floor.
It's really interesting.
It's pretty straightforward, but just there are some investors who don't invest in that. They're like, I don't know anything about retail. I don't want to mess with retail, which it's really pretty straightforward.
Yeah.
But,
there's 3 new developments I can think of on Indianapolis's north side that are, from the outside looking in, appear to be multifamily, rental housing, market rate rental housing. You get on Zillow, the top 2 floors are for sale condos for astronomical numbers that I think people would pay for a box in the sky in Chicago, but not in Carmel, Indiana. And they are mixed use with a bunch of retail on the bottom. And I was asking myself the other day, like, first of all, who's going to come buy this for $900,000? And then second, why are they trying to sell this for, why don't they just rent it out?
Somebody from
annually?
Chicago that's selling their $2 million or whatever.
Affordability, come to Indy. But so I answered my own question because then like 2 or 3 days later, I'm at a baby shower and one of my buddy's parents told me they just bought a place above, and I'm like, okay, you're downsizing. You're going to spend half the year in Colorado. You're going to spend half the year here. Makes sense.
Yeah.
But I just thought it was interesting that there's, it seems like that new model.
So I just want to understand it. So retail on the bottom floor.
Yep.
Traditional multifamily rent. Not all of condos.
Not
it's
all
multifamily, but on the top floor, for sale condos.
Yes.
Yeah.
Yeah. And three different distinct brand new developments that I think they're pre-leasing. Mm-hmm. It's not delivered yet. They don't have their CO just yet, but.
I know Carmel. They really want. They don't really want a lot of rentals anymore, but they do want for sale like condos and townhomes because they want the baby boomers, older demographic, or people who can buy a house to move property in to stay, and they see renters as coming with kids, and it puts more pressure on the school system.
Yep.
And so they're like less kids that the school has to deal with, more high tax bracket baby boomers who are just gonna be empty nesters. We want more of that. How can we build more of that? So, and that may have been. It probably made a lot of sense, but also it may have been like part of the requirement that the city really wanted. Of like there has to be a component of for sale housing as well.
The price tags are, in my opinion, very high. But like you said, somebody coming from Chicago, L.A., New York, Nashville, maybe way more palatable.
Yeah,
interesting.
Yeah.
What do we got next?
Well, we've got a great opportunity for everyone to go subscribe to the Gray Capital YouTube channel if they haven't done that. Or sign up for the newsletter at graycapitalllc.com/newsletter. And, if folks are interested, Gray Capital, we are in the hunt for new acquisition opportunities. I do feel strongly that we are at near around the trough of the market, and very simply buy low and sell high. And I think that right now is going to be an opportunity to buy low. Mm-hmm. I like this idea of kind of slower growth throughout the first half of the year, maybe through most of the year. I think it's going to make some sellers capitulate that may have maturing loans. We've been talking about that a lot over the last couple of years. It hasn't really happened, but folks may be at their breaking point. I do think we're going to see some accelerated rent growth at some point. I don't know when, but over our hold periods, which are typically 5 to 10 years, I'm not going to. I don't guarantee things, but like
it should be in there.
In my heart of hearts, it's gonna be in there. So from the supply dynamics, it's just what we've seen historically. Again, if politics turns around, we do see some immigration. If that spigot gets turned back on, that's going to be huge. We're going to see some income growth, at least temporarily, from these tax refund checks. And again, I come back to we talked about last week, and I feel like this is being discussed more and more. And it's on the same theme of why I think why central banks, why individuals are been buying up gold, and it's this return to real assets in a world where we're questioning a lot of the things that software and technology is changing so quickly, and it's making us question how we value that technology. And technology is hyper deflationary, and it has the immediate potential to really deflate the value of a lot of these software companies. I don't think the software companies are going to go away. Some probably will. There's still going to be a value of a software engineer, because even if you're great at using Claude or Chat GPT or whatever, I think you're still going to need an expert who's better at it than you are to kind of put it all together. But do those individuals need to make, $600,000, $700,000, $800,000 a year? Or maybe not. So maybe that bubble needed to be deflated a little bit, and so maybe that's all kind of normalizing things. But again, just coming back to real assets, what can I count on? What do I know is going to be needed in a couple of years? And whether we're all plugged into test tubes, they're gonna have to store us somewhere.
Yeah.
And you're gonna need some shelter. And so shelter is going to be an ongoing need. And apartments are going to be around in a couple of years, and they're going to be in demand, and rents are going to be higher in 5 years than they are today, and potentially significantly higher, or at least 12% higher. That's like pretty relatively low assumptions over 5 years. That's less than 3% rent growth for a year. And I see capital inflows coming back again. If the U.S. dollar is strong, I think the United States is in a good position. If the U.S. dollar is really weak, that makes our assets become incredibly attractive to foreign investors. And again, these are kind of real, tangible assets that do kind of hold their value. Not that there can't be swings and there can't be volatility and things can't happen in the market, can't have black swans, but just coming back to just looking core first principles, why this is even attractive in the first place, why it's considered a defensive investment, a hedge against a lot, a great diversifier, is that it's a needed, in demand, always will be required asset for society and really for life. And just how can we do it better, and how can we provide that service in an efficient way that meets the value of what residents are looking for. And then how can we do it smarter, use technology to not lose like the human element of it, but also be really smart and to create a great user experience. And that's where I'm really excited and really kind of obsessed with right now. I'm not confident. I think we have a good system and a good resident experience, but I want it to be better, and I think it can be better. I think it'd be a lot smoother. And it's just really excited to be building all of these things. We have in the last week and a half, we've got a Claude Enterprise for not the whole team, but for a lot of the team. And we've been using ChatGPT. It's great. We've been using Gemini. We've been using DeepSeek, but mostly ChatGPT. And now I'm using Claude more, and I've been really impressed with what it can do. The things I've been able to build over the last week are just kind of mind blowing. I was showing you this app I built.
Awesome.
Just at the end of last week, and it took me probably 5 minutes to build the prototype, and maybe an hour of just tinkering around with it.
Yeah.
And I built this entire dashboard display of it. I was just curious to see if I could do it, of just this threat assessment for Central Indiana, and I was pulling in dozens of road cameras, so the Indiana Department of Transportation, all of our INDOT cameras. I was pulling in air traffic control feeds seeing where aircraft was, basically a radar feed, seismic graphs. I had a police scanner that was built in, news reports.
News feed.
I had it. I was open source and open source signals intelligence gathering.
Yeah.
And it didn't work. There were things that were broken on it. I had to tell it to fix it and find it and make it better a couple times, but it made it work. And I showed it to you. And it's this is a thing. And I don't know anything about coding.
It is really incredible. You're going to be in your basement one day safer than all of us.
Thanks. Yes, you're right.
It's very cool.
I also built a multifamily deal thing.
Yeah.
Also, you could drop a PDF in and it pulls demographic. And I did it in 5 minutes.
It just seems like the use cases are infinite, and then each use case based on who's behind it, who's creating the the code and the command and the prompt can produce an infinite amount of different dashboards, different apps, different accessible, usable platforms to be more efficient, to accelerate processes, refine products. It's largely exciting to see what it can do when you're just kind of goofing around.
Yeah.
But if you have a platform, a company, a product, a service that you are really trying to hone in on and make perfect and affordable and cut costs and ensure that our resident experience is top of class. It's really exciting to think about the use of some of these tools. And
Yeah.
I think what we're doing at Great Capital is really exciting. And you mentioned this earlier today. Is we're really providing some incentivized participation into the use of AI to try and generate good ideas for Gray Capital and Gray Residential. So we're encouraging all of our team members to think about potential use cases in their current role, think about potential use cases across our portfolio, think about potential use cases in investment management versus property management versus lease execution, tours, whatever it might be. Use AI, and whoever has the best idea at the end of the week is rewarded or shouted out with the opportunity for that idea to be installed across our operations.
Yeah.
So it's really awesome when it's siloed in your office and you can sit down in your basement one night and build something for yourself personally. But
Yeah.
when you have a bunch of minds and a team that are well aware of the headwinds or the challenges for them to think tank and brainstorm about how to put this tool to use to solve real life problems or to improve services or goods, who knows what's going to come of it.
Yeah, I'm really excited, and so far, there's been no like, oh, we're gonna like let everybody go.
Right.
We just let the AI do it. It's really been more of like, we're gonna be able to get so much done. We're gonna be able to get this done quicker. We're gonna be able to free up time for teams to do more. And does it get to a point of where it's okay? Well, maybe we don't need to hire too many more people. Like possibly.
Right.
I think that's offset though by the rate of growth that we'd be able to unlock. And there will be some positions where we just don't need this anymore, like someone who's doing a really manual process that we've been able to automate.
Right.
But I do feel strongly it may not all. It's not going to. The timing's not going to all line up. But there's going to be so many other jobs that are created because of this and new. I mean, we've already seen the amount of companies that have been AI companies that are out there, and all the new like AI kind of SaaS products and AI integration products.
Right.
There's going to be a lot of like opportunity to do things, and just a little small piece of job advice for anyone that's in the job market and you're worried about this. Like, I'm not going to be able to get a job. Just a couple pieces of advice of someone that is looking to hire a lot of people right now, or a good amount of people. Some of you may be watching. Thank you for watching all the way to the end of this podcast. If you come into an interview, and you don't need to be like an expert. You don't want to like misrepresent what your knowledge is. But if you come into an interview and we ask you about like how do you use an LLM, AI at all, what your familiarity is with it. I'm not saying you need to be an expert and be like, oh well, I have 16 agents doing all these things for me. But at the bare minimum, you should be able to speak to what agentic AI is. And if you spend a couple of days ramping up your skills on it, and you go into an interview and you say like, this is how I use agents, like legitimately, you will go to the top of the list.
Great advice. And I think it's just like totally aligned with the idea of this is a tool that's here for all of us to use. There are paid models and paid services, and there's also free services.
Yeah.
Jump onto those free services and put it to use in your personal life.
Yeah.
Have it organize your personal email. Have it organize your calendar. Have it do things for you that otherwise take up time in your morning or your evening. And that way you can start to build that experience and be able to speak confidently on the agentic AI and how it can, overall reduce friction, increase productivity and efficiency. And when you speak about it, it may not be in the industry that you're talking about and wanting to be getting a job, but at least you have that base foundation. You can speak to, the advantages of having something on your behalf working behind the scenes to help increase your productivity.
Yeah.
So I was just talking to my buddies this weekend, and everybody's using it at work, but less and less of us are using it in our personal lives. And I thought it was interesting because it was like, well, if you're going to use it at work, that's good and great and all, but then you get home and now you're like antiquated back in your house and you're, cleaning up your own email. It's like, use it at home too, because it's a tool. It's kind of a sandbox, like a risk-free
Oh, I think the best. I mean, mentioned the dashboard with all the in-dike cameras. There's no like business use for that, but
Right.
it's you have to like play around and you have to experiment with this stuff, and instead of experimenting on your company or your business's time or on their stuff, it's all about just learning to use the tools, and so have fun with using the tools.
Yeah.
And then I built a like a fishing app that I put in these like already exist, but I basically just recreated one of like, it's like a dashboard. You put in, where you are, what kind of fish you want to go after, what kind of tackle, the date, and it pulls in all this information, suggestion, tides, wind, weather, sun, moon, solar, lunar, recent like reports, and again, stuff that like there's already apps that do that. I just recreated it in 5 minutes and refined it.
Yeah, and somebody that reports now directly to you.
Yeah.
Yeah.
Yeah. And I can and then it's like, what else do I want?
Kristen and I are interested, my wife and I are interested in doing like a life CFO, somebody that's like, just making sure that, when the credit card gets swiped, it's not getting swiped too often for too much. And
like kind of financial, like
set
kind
some
of
goals,
financial planner, but
right.
like not, you don't have to actually call them.
Yeah, maybe not necessarily like, hey, you should invest in in Nvidia stock, but hey, you've got
eaten
this
out a few too many times this month.
Exactly.
Like, why don't you guys do a little like meal prep this week?
Right, exactly. Somebody that's a little bit, my spreadsheet on our personal finances is crisp and clean, and it makes sense to me, and I think that's really all that matters. But it's probably going to be able to pick up on trends and potentially highlight areas that maybe we're double spending with. She's got a Netflix and I got a Netflix. I think there's apps for that, but it would be fun to build out a Haddad family CFO.
Yeah.
Agentic AI would be kind of interesting. We talked about it the other night, and I was like, it seems like a really good idea. But
it's exciting.
The use cases are endless.
Yeah, they are, and again, the residents are going to be there too. And if you're not optimizing your websites for LLMs to crawl and pull information, you need to now. Well, we could keep talking about all this stuff for an infinite amount of time. Thank you for watching this episode of the Gray Report. Again, check us out, graycapitalllc.com. None of this is investment advice. We only take investments from accredited investors. If you were even considering that, catch you on the next episode.
Yeah.
Thanks.